Hey guys, welcome back to the channel. Today I'm going to review SoFi's Robo-Advisor. Now, I've already done reviews of Charles Schwab's Intelligent Portfolio and Vanguard's Digital Advisor, and I'll link the videos on those reviews below in the description. Now, SoFi offers an automated investor like many of the other brokerages, and currently it's a 0.25% annual advisory fee or 25 basis points. And this just means that every year you're going to pay 0.25% on the total assets that are managed under this robo-advisor. So when I'm evaluating a robo-advisor, I like to use a number of criteria to evaluate whether it's good or not. And I've done this for the other products as well. And in this video, I'm going to go over a few different things. The first thing is I'm going to look at how easy is it to set up and use. Then I'm going to look at their asset allocation. I'm going to look at the ETF and Securities Selection. I'm going to look at their advisory fees and then other associated fees. And then I'm going to look at sort of like what are their rebalancing policies. So to get started, I'll say that SoFi's Robo-Advisor, what it does really well is that the setup process is very simple and fast. So you'll see that it only takes about 2 minutes for them to figure out what your investment goals are. Once again, as I recommend always, I suggest going with an aggressive portfolio over a long period of time. This will just make sure that your portfolio is allocated to more equities than it is bonds. But you'll see when you get started, it sort of just like gives you a really quick introduction into sort of like what you're going to be looking at, right? So you're going to have to like go through a couple of things, including sort of what the investment strategy is going to be, what your personal details are, and then your financial information. And this is all information that they use to gauge sort of what time horizon you have, what is your income looking like, and what you're planning to do with this money. After that, it gives you 3 different options on how you might build a diversified portfolio. And interestingly, there are 2 that make a lot of sense to me. The classic, which is, what I generally recommend is a passively managed approach where all the ETFs and index funds that you use are based on benchmarks on index funds. So this keeps it very low cost. And it's generally shown that active management doesn't outperform index funds very often. So I think you can't go wrong with reducing the amount of fees that you pay by going with index funds. The alternative is they have a classic with alternatives, which includes real estate, private equity, which gives you probably some more active management. This just means that it's going to sort of stray from the markets a little bit. And it probably also means that the fees are going to be slightly higher as well. Lastly, something that's been, very popular lately is what we call like ESG investing. So it's sustainable investing. So this type of investing will favor companies that are ahead in environmental, social, and governmental policies. It's generally seen as a more moral investing strategy. However, it's also been shown that these will probably be lower returns in general. And then it goes over sort of what are your main goals for this account. You general investing, saving for retirement, funding a large purchase. This will just help them figure out your time horizon and how much you're willing to risk as far as the assets that you're willing to purchase. And then it will ask you what your time horizon is. And this is really important because it's going to look back and see, how much volatility are you willing to withstand over these different periods of time. And if you're looking at over 10 years, generally you can expect to invest pretty aggressively because over any 10-year period, essentially, the markets are up. That's not the case all the time, but if you look back over time, 10-year periods tend to smooth out the curve a lot. If you are setting this account up and you're just, approaching this from a long-term strategy, I would definitely recommend picking more than 10 years. And so the last question really is just asking you, how much is your risk tolerance? So the 2 options are growing my money, even if it means higher risk, or preserving my money, even if it means less growth. And of course, this is up to you. But once again, I will encourage you to take on a bit higher risk and see your portfolio as a really long-term strategy. This is about building wealth and maintaining purchasing power over the longer period of time. So as far as onboarding goes, really, this is probably the simplest that I've come across in any of the robo-advisors. And it's really the most straightforward, I would say. When you log in, you'll also see that there's a pretty simple user interface as well. I'll say that SoFi's UI is pretty good. It's intuitive. It gets the information that you need right away. You see your performance over time, your balance history. You can see all the transactions, all the purchases that have been made. It kind of pushes you to create recurring transactions, recurring contributions to your account. Obviously, that's an incentive for them to get more money here. It also wants you to transfer assets to SoFi as well. All the brokerages are going to push you to transfer other assets here because they want to have as much of your money as possible. So these are very simple things. It's really treating the investor with kid gloves. And for the most part, that's a good thing. You don't really want to be making too many choices. You don't want to be making a lot of transactions. You really just want to set it and forget it. And then you can see the current holdings that you're allocated in. And so in my particular case with an aggressive portfolio, so you can see that they've placed me in a bunch of different ETFs. And I would say that it's a pretty standard portfolio allocation. You know, it's heavily invested in US equities. And most of these are passively managed funds. They even chose a couple Vanguard funds for their international and emerging markets funds. And then iShares is their other choice for US equities mostly. SoFi does have one S&P 500 ETF. So, you know, you're getting a fairly sizable US equity allocation. And then a bit of emerging markets and international markets. I would say on the whole, it's very US focused, which isn't necessarily a bad thing. SoFi's automated investor tends to favor the US markets. Just go through the holdings that they put us in. So we can see that there's the BlackRock US Equity Factor Rotation ETF. This tends to be like a larger mega cap ETF. It holds a lot of stocks that you've heard of. So it holds NVIDIA, Apple, Meta, and Google, among many other large companies. So this is a very traditional blue chip stock portfolio. And, you know, blue chip stocks have done really well. These mega cap stocks have done well over the past year, couple of years. The next two that they invest in are S&P 500 ETFs, which are split by value and growth. And so, you know, value and growth stocks are sort of what they sound like. Growth stocks will tend to grow more, and value stocks tend to hold their value more. And so they have a slight favoring towards growth stocks in this market. We'll see like how they rebalance later, or if there are sort of shifts that they make, depending on the market. But right now they kind of favor growth in between those two. They have a iShares Global Energy ETF too, which is, you know, going to invest in a lot of energy companies. We can see that, you know, they have ExxonMobil, Shell, ConocoPhillips, Chevron. So these are, you know, oil and gas companies that you're very familiar with. And having a bit of energy in your portfolio will give you some diversification. Right now, they also are including a sector ETF. So they have the iShares US Technology ETF, which, you know, will also invest in a lot of the companies that we heard of in the S&P 500, which, you know, will be mega cap stocks. So some of the big holdings are Apple, NVIDIA, Broadcom, Oracle, Meta, Microsoft. So again, you're doubling up on a lot of these really big stocks in your portfolio. So it just means that this Robo-Advisor is tending to favor these companies a lot. And so you're actually getting exposure to them over multiple ETFs. After that, we have sort of the biggest position in the portfolio at 43%, and that's SoFi's S&P 500 ETF. And this is very standard. You know, this is going to invest in the top 500 companies. It's probably the most widely cited passively managed index fund where every robo-advisor is going to place you. And the S&P 500 has done really well over the last few years because US companies have done really well, especially larger cap companies. So if you're taking the top 500 companies, your portfolio will have done very well. And finally, we have some allocation to international markets. And again, they're using Vanguard ETFs here, which, are great. I always recommend them because they're low cost and passively managed. And we've talked about some of these before. VEA, which is their developed markets ETF, and Vanguard's emerging markets ETF. Again, the developed markets ETF is going to just invest in developed countries outside of the US. So you're talking about Western Europe. We're talking about Australia, probably any sort of economies that have reached like a steady state. And then the emerging markets ETF is going to invest in other countries that are still developing or seen as growth markets like China, Brazil, India. So those will be more volatile, but will have potential for higher growth. So as a whole, the asset allocation is fairly standard with, I would say, like a bit more sophistication or diversity than even the Vanguard digital advisor. If you watch that video, you'll know that they basically only placed me into two funds, one international fund and one US equity fund. And so that's a pretty simple asset allocation. Not that it has to be any more complicated than that, because as you'll see in this portfolio, you're going to get a lot of overlap with the companies that are in each of these funds. So you'll see that if you have multiple ETFs that are covering the US equity market, it just means you're doubling up on companies like Google, Nvidia, Apple, Microsoft. You're going to get a lot of exposure to those companies. So it's really a question of whether like that makes sense, It'll be interesting to note whether they shift out of certain ETFs as the market changes. So I haven't had a chance to like live with this portfolio for a very long time, but they could opt to get rid of some of those holdings as the market changes. Okay, so we've covered sort of the ease of use and the ease of setup and the asset allocation. We've talked about sort of the ETFs that they've selected. I'll really quickly, as I've sort of already mentioned, talk about the fee. Now, it had been quoted before to me that this was a free product, but actually it's now charging 25 basis points, which, is in line with other robo-advisors. I won't say that that's like good or bad. It's pretty standard. I would say that these advisory fees should come down over time. To be charging an extra 0.25% on all your assets is actually a lot comparatively. When you're talking about the S&P 500 ETF only charging 0.03% as a management fee, that is like 1/10 the cost of the advisory fee that you're paying here. And you can really easily achieve this portfolio without it. So again, the Robo-Advisor is good if you don't want to have to think about it at all, but really you can save yourself some fees, and by saving fees, you can increase your performance over time by just buying the ETFs outright. As I did with Schwab's Intelligent Portfolio, I also looked at the underlying expense ratios for this portfolio. And in the same way that I didn't love how expensive the ETFs that Schwab put me in, I also have a similar gripe with SoFi's Robo-Advisor. So as you can see here, I took the equivalent Vanguard funds and took their expense ratios and found an effective expense ratio for the entire account. And you can see that the Vanguard equivalent is at 6 basis points, whereas the expense ratio for my SoFi Robo-Advisor is at 21 basis points. So again, that's more than 3 times as expensive. On top of that, you're paying the 0.25%. You're spending almost 50 basis points on fees. Whereas with your Vanguard, even with your Vanguard digital advisor, you're only spending 21 basis points. So basically, an equivalent portfolio is half as expensive with Vanguard's digital advisor. And again, this just means that you're going to eat away at your performance returns, because if you think about it, you're just paying this percentage by reducing the performance of your portfolio every year. So I would say that SoFi is a little expensive for what it is. And if you can, you may just want to purchase this portfolio with a self-directed investment account. They have their own self-managed accounts that don't charge an advisory fee, and that might be the way to go. Lastly, let's talk about rebalancing. So I haven't had it long enough to have my portfolio rebalance, but according to SoFi, the Robo-Advisor looks at the portfolio on a daily basis, and runs an algorithm to see if any one asset is more than 5% off its target. So that's actually identical to the Vanguard digital advisor. They also will only rebalance when you're off your target by 5%. As far as evaluation criteria go for SoFi, the best things it has going for it is that it's a really easy setup process and the UI is pretty intuitive. I would say neutrally, the advisory fee is on par with other services, and rebalancing is basically the same as the digital advisor. What I will say isn't great is that they put you in pretty expensive ETFs, and with that on top of the advisory fee, I think it's an expensive product overall. And on top of that, I'll add one UI qualifier, and that's that the UI, while intuitive and useful, is pushing you to make transactions. So if you go to their homepage, you'll see that they're trying to get you to, use SoFi for everything, to invest in other assets, to bring your assets over, to trade more often, to get a loan. And so what I'll say is, with these products, I don't think you should be doing much with them. I think you should be setting up automated transactions and really just leaving them. And SoFi is going to sort of gamify your experience and try to push you to do other things. Again, you probably will be okay if you use this product. It's not terrible, but if you're trying to optimize for performance, I would say truly just create a self-managed account anywhere and buy some Vanguard ETFs. And you can use the portfolio allocation that's laid out here with the Vanguard ETFs that I've shown you, and your expense ratio will be really, really low. The effective expense ratio, again, on the portfolio here would be 6 basis points, which is a very low expense ratio. I'm gonna probably continue to explore more products out there and do reviews of them, but on the whole, I would say SoFi's Robo-Advisor is somewhere in the middle. If you're looking for something really simple to get started with, I'd recommend it. But I would say if you want your money to grow faster, I would try to reduce the number of fees and just use a self-managed account.